Well, thank you, David, for having me back to speak. And you're absolutely right in your introduction of the talk. What I'm going to do today is talk to you the high-level themes of investing in the Middle East from the perspective of the companies that we follow at Bernstein. So for those of you who don't know who we are, we're a Wall Street equity research firm, and we cover stocks in the majors in Europe, some E&Ps, and the Russian majors as well. So that clearly leads us to look at all of the factors that will affect the commodities, which in turn dictates whether the companies make any money. And there's no region more relevant to that than the Middle East. So I'm going to start out with a little story. And about a couple of years ago now, I went to a friend of mine's wedding who's country director at the IMF. And I don't know if any of you know anybody from the IMF, but they tend to be very diplomatic, personable people. So naturally there were lots of other IMF people at the wedding. In fact, probably so many that was it a wedding reception? Was it a delegation? It could be either. You could say it was either. And one guy, former country director from a Middle Eastern country, told me a little fable told to him by, in turn, an oil executive. And it was about the investment climate in the Middle East as this executive happened to see it. And it was the fable of the scorpion and the frog. And it goes that one day the frog was swimming across the Euphrates River, and just on the wind a scorpion just by chance blows onto his back, right, and lands on his back, and he looks up and he's like, oh God, there's a scorpion on my back. The last thing you want as a frog on the Euphrates River. And he says to the scorpion, please don't sting me. We're in the middle of the river. If you sting me, then I'll drown, you'll drown. It'll be bad for both of us. Let me take you to the other side, and I'll drop you off, and we'll both just go on with our lives and live happily ever after. And the scorpion agrees, and the frog starts swimming. And about 2/3 of the way there, and the shore is almost in sight, the frog feels this like terrible pain in his back, and he looks up and he says, "You fool! Why did you do that? Now we're both going to drown." And the scorpion says to him, "This is the Middle East," and that is. I think what some investors actually think about, putting money in this part of the world. And I'm going to say today, the reason I bring this up as my starting point is I think that is actually a really unhelpful generalization, because there's 3 points that I want to make. One, it leads to the Middle East being overlooked as a region, and that's what I'm going to talk about in my first set of slides. It's vitally important to global supply-demand picture relative to the attention that it gets. And actually, I think that if you look at where the market will get surprised, where the volatility will come from, it will be in a place that you aren't looking, right? That's what history tells you. And the second thing that I think I want to challenge about my story of the frog and the scorpion is the idea that it's not worth investing in this part of the world. And the reason for that is, if you look at the returns that some of the companies we follow have made this year, the best returns have been made by the companies in the Middle East. And so we'll talk about that a little bit. And then the third thing is, you see all this talk in the press at the moment about US shale and how the US is the next Saudi Arabia. And I just don't get that at all. From everything that we see, the opportunities to find easy hydrocarbons are just chalk and cheese from the Middle East to the rest of the world. So that's the third set of slides I'm going to show you as we move through the discussion. So this is to that final point. What I've got here is my favourite way to gauge sentiment about things that are completely unquantifiable, and it's to put into Google this Google Trends analysis you can do, where it will tell you how many people search for different search terms at different points in time in the past, right? And if you look at the black line on this chart, what you have is the search terms, just how many people are searching for OPEC. And if you look at the red line, it's how many people are searching for shale. And if you go back to 2004, 2005, there's like 3 times the amount of interest in OPEC versus shale. And if you fast forward to the present day, it's exactly reversed. There's 3 times more interest in shale than OPEC. And I think part of what drives that is the perception that the shale is here and it's ours and it's a giant opportunity that you can actually invest in. But if you look at the volumes, this year we're about 2.5 million barrels a day of shale oil liquids production. What is it? About 850 from the Eagleford, 900 from the Bakken, the rest Permian and other NGLs. But if you look back to 2004 to 5 and look where the growth has come from, that 2.5 million barrels a day of growth from shale is still almost half the peak growth we had from OPEC, which until in 2012 when Iran was curtailed, ramped up to just over 5.5 million barrels a day. So in terms of and that's the growth, by the way, from the 2005 base. So the actual number is going to be 36 million barrels a day, so an order of magnitude higher. And yet all of shale at 2.5 million barrels a day gets 3 times the attention of all of OPEC at 36 million barrels a day. So that is a little bit surprising. And then the second way that you can look at it is the Energy Daily, which is what I have the misfortune of having to do between about 5:30 and 7 a.m. every morning. I come in and round up the news for our clients, everything that's happened in the last 24 hours in one email. And I have this giant database we've been building up for the last 3 years of all the news stories, right? And what you can do if you have a bit of foresight is when you look at these news stories every morning, just categorize them by, is there anything specific about them? What countries do they involve? What companies do they involve? What type of event is it? And then you can do all these very interesting things of looking at how the news actually drives the stocks or how the news changes over time and find out interesting things like, companies report 10 times the number of exploration successes as they report exploration failures, which clearly is not a good indication of the global success rate to exploration. But what you can do is look at the countries who features in the news, right, relative to their production levels. And on the one side of the spectrum, in the top left-hand side of this chart, you have countries like Norway, the ivory tower of excellent reporting. And I think this is a country that has 5% of the news flow in spite of having 3% of the world's production. And on the other side of the spectrum, you have the Middle East, right? Saudi Arabia is right in the bottom right-hand side of the chart and has just under 10% of production and just under, I've got the number here, 2% of news stories. And likewise, Kuwait, UAE, Qatar, 0.2, 0.3% of the news stories and 2 to 3% of global production. So greatly underreported. And that's to my point that I think that's where the holes in people's oil supply demand models really are, because nobody's looking at them. And they should be. So this slide, I'm just doing a round the world tour of the Middle East in terms of its hydrocarbons. So you see that it's a region that has got 50% of the world's oil reserves. We're talking about 800 billion barrels just proved today. And 26% of the world's oil production and just 9% of the world's oil demand. So 23 million barrels a day of oil production, 8 million barrels a day of demand. And what's interesting here is the gradation, right? If you have more production than you have demand, then you're an exporter. And if you have more reserves than production, you're going to be an even bigger producer in the future, theoretically, if exploration is the same around the world. And the same story is true with gas. So we have 80 TCM out of the world's 187 TCM of total gas reserves, 500 BCM of gas production in a 3.4 TCM market, and actually much more closely matched in gas in the sense that we produce 500, we consume 430 in the Middle East. So the amount that's there for LNG exports is left at just 36%, I think that says. So 100 million tons a year of capacity in a 280 million ton a year market. And actually that's an interesting one, because of all of the bars, you see all of them are increasing, right, except the LNG as the Australian projects and eventually East African projects ramp up. The Middle East will actually fall in its share of LNG, which is the odd one out here. So I think that the number to keep in mind as we flip to the next slide is 26%, right? 26% of the world's oil production is from the Middle East. When we look through our coverage companies, i.e. the global oil majors and the E&Ps, where does their production actually come from? And relative to that, 26% of the world's oil coming from the Middle East, look, in their portfolios, I've broken it down here in this Marimekko chart format, and you can see just 12.5% comes from the Middle East. So clearly, in terms of the mix shift, the listed oil companies by market cap are much more exposed to North America, Africa, Latin America, Europe, much less exposed to the Middle East. And the breakdown within each category is also, I think, quite interesting. You see that there are some places like Africa where basically it's all offshore oil, right? 2/3 offshore oil, and kind of similar story for Latin America. I think that's because Petrobras is in the sample as well that it gets such a big share. Europe, very, very gassy. Offshore gas actually has a significant role in Asia Pacific and Europe. Middle East, it's quite even. 40% of it is onshore oil. That might seem high on a global basis, but it's quite low in the sense of where the Middle East oil actually comes from, in the sense that 75% of the Middle East total hydrocarbons production is oil, and almost all of that is onshore. So then it raises the question of, well, what is making up that actually quite small portion of global companies' Middle East exposure? And the reason it is so small is the biggest challenge for investing here, and it's access and its terms. So the way we always think about this is in terms of a metric that we call the total fiscal take. And effectively what you do is you take all of the oil produced, all of the gas produced, work out its gross value, and then subtract out operating costs, and then look at that pie that's left to carve up of gross production net of operating costs. Where does it go? I.e., what percentage goes to the operators, what percentage goes to the governments? And the global average is about 71% goes to governments. Better to be a government than a company, remember that. And in the Middle East, it's as high as 85% goes to governments. And you see that it's kind of interesting on this chart that the production levels correlate quite closely with the fiscal take, right? So if you're a country that has huge reserves, huge production, you tend to have a higher fiscal take overall, and that is why Saudi Arabia, Iran, Iraq are the highest dots on this chart here. They're on the chart, but I guess you could maybe say they shouldn't be. So what we're doing here is just taking the contracts that we know about, contracts where we can actually see them, they're a stake in the ground, they actually exist. It's not really as though many of the global majors have any production in Saudi Arabia, right? It's on the chart, I think, because a number of years ago, the Saudi government said to, and I think it was Total, you're welcome to go and explore in the middle of the desert, and we don't think you'll find anything, you might not even survive, and if you do find anything, well, it will be a 90% fiscal take on it. Iraq, clearly at the top there. We've been a little bit cautious on whether this is really worth doing for the industry, and the fact that these contracts are structured as service fees, i.e. $1 to $2 a barrel as just a flat fee for every barrel that you extract once you get to a certain production hurdle, plus the cost recovery. And even that gets taxed at 35%. So the fiscal take there is the highest in the world. And although you can get access, unlike Saudi, it's arguable whether or not the returns are really going to come in, especially given some of the challenges that we might talk about in a bit. So what you'll notice is that the places that have the lower fiscal takes, the Omans, the UAEs, the Qatars, well, that's where the companies tend to be. So if you split out that same set that I was looking at before, just where are the global majors' Middle East production from? It's offshore gas in Qatar, the North Field coming into the Qatar gas and the Pearl projects. It's the onshore liquids in the UAE with a 75-year concession set to expire next year, much to the concern, I'd say, of Total, Shell, BP and Exxon, who will basically have this concession ripped out from under them and then offer the chance to have a $1 a barrel service fee to continue operations there. And the other names on this list, it's Qatar, it's Oman. So it is the areas with the lower fiscal take. So that's where you want to go as a company if you're going to be investing in this space. So there's risks, there's access problems, there's fiscal take. Nevertheless, when you get it right and you walk the line of investing in this region, the returns can be really, really good. And that's what brings me to this chart. So this is the indexed stock performance of just the 25 key names that I'd say I'd look at. And I'm sorry to David for putting the chart. It's been a really tough year for some of the really loved explorers. And it seems like this year you can have a great portfolio, but if you have one or two dry wells, then the market has just been absolutely just brutalizing the stock price. So Cobalt, you'll see, is the second bottom green bar there, and up until halfway through the year, it would have been about flat. And then yesterday they came out and they said, yes, we did make a multi-billion barrel discovery off Angola, but it was all gas. And the stock is down 30% in a couple of weeks. So, it's been a really, really tough environment to be operating this year. But on the left-hand side of the curve, you'll see the top performers, DNO, Genel, Afren. I mean, the one thing that groups all of those companies is they all happen to have exposure to Kurdistan. TAC, Tauke, Afren is in different fields. And for the first time this year, I think the market has really gotten excited about the prospect of getting this oil out, right? So people have gotten behind that story, and I would love to have made 140% with DNO, but of the minefield of companies you could be invested in, can you call it? Can you predict when the tide is going to turn in these politically driven stocks? I think quite tough. I had a meeting with the Kurdistan de facto foreign minister a couple of weeks ago. As an oil analyst, it's like your dream when you get time to ask this kind of important person questions. And he was just unbelievably vocal. He said, the Iraqi state budget is a punishment law for Kurdistan. We will get the oil out. There is no doubt about it. And when investors hear that kind of thing, I think it makes them start to believe, and that's why these stocks have done so well. So walking the high wire for them has been a very effective strategy, and so far so good. The one thing I'd say before moving on is that if I'd shown you this chart a year ago, the top stock a year ago is now the bottom stock, and the bottom stock a year ago is now the top stock. So will things continue as they are? Well, I guess you have to have me back in a year's time to tell you. So this is just Kurdistan, a little model that we made of it. I mean, I just think it's interesting that Kurdistan is still a place where there's enormous political risk, enormous challenge getting the oil out of the ground, an incredibly high 90% fiscal take on that same metrics I was showing you before. But if you can make $5 to $6 a barrel of net income after $1 to $2 a barrel of upfront capex, and find 8 to 10 billion barrels as Shaikan is, then you're still making really, really good money. So that's where I want to turn to the resource side of things, and some numbers that we look at that just say the opportunities in terms of hydrocarbon potential just vastly superior in the Middle East, if you can get it, than other regions globally. Oh, gone too far. So this is no great insight to collate this chart, but it's the USGS shopping list of the 10 greatest untapped basins in the world in terms of their hydrocarbon potential. And you'll notice that 5 of them happen to be in the Middle East, right? So of the total, you have 140 billion barrels unfound in Saudi Arabia in the Rub al Khali basin, and I can just go down the list. You can see it for yourself. The shading here is meant to indicate how accessible they are. So you'll see all of them are shaded black, which means basically inaccessible. But you see I've shaded the Zagros fold belt just slightly white towards the top, which is people going into Kurdistan and benefiting from that resource opportunity. And I think you'll see more of that, and probably more majors entering next year. So that's where the untapped hydrocarbon potential apparently is. And the other place you see it is just the reserves to production data. So if you go through every country in the world and you divide their total proved reserves by their total production, it gives you the number of years of remaining reserves. And you see here we are in the UK, and we're languishing down at 7 years of crude reserves, according to this data. We're better than Colombia, so we can hold proud about that. But the Middle East, I mean, it's 73 years on average, which is 1.5 times higher than the global average and 3 times higher than the non-OPEC average. And if you're Kuwait, Iran, Saudi Arabia, Iraq, I mean, you have about 100 years of production levels. So these regions are not running out of oil, and they will get more important in the global mix, because I think exploration-wise, last year, the numbers I have in my head, we found about we used about 50 billion barrels of oil equivalent, and we found about 25. So something has to change in terms of the discovery rates in order to get close to avoiding this inevitable shift to the Middle East. The other way in which I like to think about it is in terms of the resource intensity. So, what's the best way to explain this one? Well, look, if you look at the rigs that are operating in the different countries globally, and you just take the country-reported rig count and divide it by the production in the country, you get a sense of how many rigs need to keep going, keep spinning all day, every day to maintain production levels or grow production levels. And people talk about the US being the next Saudi Arabia, and I think the reason I just say no way is because of the rig count. So in Saudi Arabia right now, you have 90 rigs going in order to sustain what is 10.5 million barrels a day of productions, if you're generous in the way you count the NGLs. I think it was 9.5 of just pure oil in November. So when you do the math and divide one by the other, you get 116 is it rigs per MBPD, or is it the other way around? I can't quite remember now. KBPD per rig, there it is. I put it on the axis. Well done, me. And in the US, on the other side, you have 6 KBPD per operating rig. You have 1,700 rigs going there in order to keep the production flat. So if you think about where the resource is, just in terms of the maturity of it, it's just a completely different game. You have, on the one hand, Saudi Arabia's completions that just stay flat, and they have a lot of the smart completions on some of the more recently developed fields, where they can just screen out some of the zones that start to flow in water when they come in. Versus on the other side of the spectrum, Russia, we all know, has like a 90% water cut on the wells that it's producing from. In the US, the shales have like a 40 to 60% decline rate once you bring them online. So these things, you just have to keep drilling them. Completely different. And that is why, ultimately, if you can get access to the resources there, I think for the industry, it's such a great prize. This is something we put together every year, and it's just going through the 10Ks and the annual reports of the 50 largest non-OPEC, non-Russia oil producers. And what we do is we measure the end-to-end costs of finding, developing, producing, and commercializing a barrel of oil in all of those companies' portfolios, and you rank them in this kind of cost curve, and you end up with just under a third of the world's oil production in this chart. And if you take the upper decile, that's the methodology for marginal cost in the industry. And in 2011, it was $92 a barrel. In 2012, it was 105. Some concerns about, is the methodology giving you a fair number there because of the great increase in spending that hasn't yet been booked in reserves? But basically, it's saying that $90 to $100 a barrel is the marginal cost for the industry today. And when you compare that to $1 to $2 a barrel in the Middle East, and maybe $5 a barrel if you use Russia as an analogy for the operating costs, you can see that there it's possibly closer to 10, 20, and that's just very, very, very different. And companies that could get that in their portfolios would impress investors and make people really want to buy them, because capital discipline is just the new watchword from the investment community at the moment. Any company that says the words peak capex in their investor presentation recently is doubly exciting. And this is a chart with lots of numbers that you probably can't see, just going into a bit more detail about the run-up in OPEX in the last 10 years. But I can't see them either, actually. but I know them, so it's fine. We've had a 16% CAGR in the Brent price in the last 10 years, and with that, the marginal cost, the cash cost are also rising at 15%. So, it is the cost that's driving up the price of oil in the world, and that just highlights the importance of the low-cost oil. The next set of slides I've got, I just want to look at the exploration potential and show, again, the difference here. These are charts plundered from an IHS database of where the wells are drilled on a kind of rolling 5-year period. I think this is 2005 to 10. And what it shows you is that the North Sea or the Gulf Coast of the United States, you just have this constellation of drilling, constant. In the North Sea last year, I think we had 66 wells drilled, of which 2 were discoveries. So incredibly disappointing. But this year we've done better. But I mean, the levels of wells we're talking about here is in the hundreds, right, per year. And then the same slide I have just for the Middle East, and you see that in the core areas where the resources are, that's on the right-hand chart, the greens are the oil fields and the reds are the gas fields. I mean, you basically have negligible exploration. This chart is a much bigger area than the North Sea that I just showed you, and yet you visibly have way fewer little dots. Oops. And the dots that you do have are in countries like Yemen and Oman and around the Levant, because that's where the majors have access to go in and drill for the resource, but still much less. And the reason for that is, I mean, it's the obvious one, that when you're sitting on 180 billion barrels, as some of these countries have proved reserves, you don't need to go and drill for the new marginal reserves. Send Total out into the desert to do that for you. But it's just, anything you find you have to discount by, 80, 90 years anyway to get it out. So, and it's the same gesturing from the OPEC oil ministers when they meet every year. I mean, they are adamant they have the resource and can produce it if they need to. And there are people there who don't believe them, but for the most part, I'm pretty comfortable that Saudi could produce 12.5 million barrels a day if it absolutely had to. So I think in terms of getting that oil out of the ground, fine, they don't need to explore. And this just highlights that again. It's the breakdown of the total number of wells in all the different regions globally. And what you see is that in a region like Europe, let's pick on Europe, I'm European, so I feel I can. We've drilled 25,000 wildcats in the last century, and in the Middle East we've drilled 4,500. And then if you divide the total resources found by those wildcats, roughly to indicate what's found per well, the numbers sort of make sense for Europe, sort of makes sense for the other countries. You get between 50 and 150 million barrels, and then the numbers just don't make sense for the Middle East at all, because it implies that you found something like 1.1 billion barrels per well that you've drilled, which I think, I think about that. A large deep water discovery, the average in the last 3 years is about 700 million barrels for a large frontier deep water commercial discovery. So to be getting that kind of rate, that says to me that there's a lot of resource being counted here that hasn't actually been drilled up, but it's what the numbers tell you, and it just shows again why exploration is so low. But actually interesting, the exploration that you do has a higher success rate than the global average, 33% versus 27%. So they aren't exploring, but if they were exploring, we think they could find it. So again, we're not cautious about their ability to ramp up supply if they need to. These were 2 charts here that I put in as my final 2 on the resource opportunity, just because I spent about a day of my life getting frustrated at Excel, getting the leader lines right in between the different bars. This is a breakdown of the world's total energy production. So on the left-hand side, you have the sources, i.e. coal, oil, gas, nuclear, bioenergy, etc. And on the right-hand side, you have where it ends up, i.e. transportation, industry, buildings, electricity, and lost in distribution. So that's the whole world, and you'll see that oil is, I think, just under a third there. And what is it? 20% goes into transport. And I've got the same chart for the Middle East, and it's like dramatically different. So there's the world, and there's the Middle East again. So good news. If I can work the clicker, no need to rely on coal or nuclear or anything else. Just a 50-50 split between oil and gas will work for this region. And even in power generation, look at the yellow box in the middle as I try to flick back and forth again. If you look globally, 50% of power comes from coal, about 25% of it comes from nuclear and renewables. But if you go to the Middle East, fine, oil and gas, all you need. And again, the other little difference here, when I flip between them, I like the change in the transport share on the right-hand side. So if you see on the right-hand side, the second bar from the, oh look, I have a pointer, very good. 19% in the world of energy uses into transportation, and in the Middle East, it's as high as 30%, and that's what happens when you can go and buy oil for cheaper than water, as you used to do when I lived in Libya. And I missed that, I'll tell you. So I guess the final thing I wanted to talk about is just our very, very bullish view on the oil price for the end of the decade. And this is something I've touched on before, and I really just want to end with it just because of the importance of the Middle East in buffering the oil markets. But our view as a team has always been that the decline rates of conventional resources in the non-OPEC world are probably 4 to 5% higher than typically assumed by countries and by other forecasters, and that's based on analysis of 77,000 wellbores that we've looked across in the last 3 years. And when you run that through into our model and add it to a pretty cautious view on how far shale can ramp up, and I think also the demand declines in the OECD are a bit overrated. Where you come out is with a view that OPEC spare capacity is just set to decline here as more and more of the Middle East resources are called into production. And you see that historically that's the best predictor of the oil price. I mean, if you want one single metric to look at to make everything else fall into place, you get about a 70% R squared between OPEC spare capacity as a percentage of demand and the ratio at which oil trades to its marginal cost. So in terms of requiring that resource, well, we do require it, and that's what will drive the oil price higher in the future on our view. And David, how am I for time? I mean, am I pressed or keep going? Okay. So if you look at where that spare capacity comes from, I've said this is just the key factor for predicting the oil price. It's about 2/3 Saudi Arabia. So, we talk about OPEC spare capacity, but personally, I think sometimes it'd be more sensible to talk about Saudi spare capacity, especially because if you look at countries like Libya, Iran, Venezuela to some extent, Iraq to some extent, there's real problems with getting the oil out. So if you look at who's actually there and can buffer the markets in a supply disruption, it is Saudi spare capacity to a large extent, with the rest coming from UAE, Kuwait, who are also in that mix. But Saudi spare capacity is the name of the game, and that's because Saudi makes up 41% of the Middle East's oil production. I've split it out for you here, just where that oil actually comes from. But you can see on this chart on the left-hand side, what I wanted to highlight was that because of those factors I mentioned before, we should grow from 23 million barrels a day of Middle Eastern production this year on our numbers to about 30 by the end of the decade. So in terms of an area that becomes important, well, it's going to become more important by another 30%. So the key areas of uncertainty, and happy to talk more about this if we do a bit of Q&A afterwards, I think is Iraq and Iran. They're the areas we get asked most about by investors. For Iraq, it's because of the just astronomical numbers that they suggested to the market that they'd be coming out and producing. I think if we'd gone back 3 years, they would have been promising 12 million barrels a day by 2017. And I'd say they probably get to 6 million barrels a day by 2020 if we're lucky. You've just seen another 2.5 million barrels a day of cuts to their target. So last year they cut from 12 to 9 and said we're going to get to 12, or only going to get to 9. This year they've just agreed deals with Exxon, BP and Shell to shave off a combined 2.5 million barrels a day from the plateau targets at Majnoon, Ramalia and West Kona 1. And I think the direction is clearly trending down. And it's nice when you develop an oil field when you don't have to clear an area the size of Hyde Park from landmines before doing any drilling. And I think the industry has just comments from the companies continues to suggest that the operating environment has been more challenging than has been expected. And then on the Iranian side, this is clearly the biggest wild card in terms of the oil markets right now. And on the one hand, we've been through this before. So as you know, we've lost about 1 million barrels a day of production from Iran. We're down at 2.7 million barrels a day now, and that's because of the US sanctions that have blocked any imports by countries that used to import their crude. And now it's looking really interesting because it was just a couple of weeks ago that the Iranians and the G5+1 agreed landmark deal to dismantle the network of centrifuges and cap enrichment to 5%. And people are starting to think, well, will that lead to an end to sanctions next year? And so far people have been cautious. We haven't seen much of an impact on Brent. But it becomes a question of can the fields come back and will they come back? And I think on the can they front, this is this really, really great analogy from the 1950s because we have been through this before. So between 1951 and 1954, when Iran nationalized its oil industry, they took 700,000 barrels a day of production and just shut it in completely. It was running about 20,000 barrels a day, down from 700 for 5 years. And over that time, engineers at the British Petroleum Company, today's BP, monitored the pressures in the wells, and miraculously they all built up again by about 0.2, 0.3% a year. And some of them actually built right back up to when they were first brought online. So this says that once you shut in these wells, as you've done with some of the Iranian fields, you can turn them back on again. They'll come back even stronger than when you turn them off. Will that happen with Iran? I think our view is cautious. So even though the resource is there from a reservoir perspective, the state of deterioration above the ground is just abysmal. You have, going back to my little news database that I was telling you about, you have one of the highest incidences of fires and production problems and infrastructure deterioration are reported there versus other places, and little data points that are kind of worrying, like when your national gas company declares bankruptcy. So, Iran is now talking with 7 Western companies about returning to the country when the sanctions are lifted, but I think it will be a longer haul to raise production, and certainly the contracts that are being developed right now, CNPC at Azadiga and Sinopec at Yadavar, they're like way behind schedule. Like 50% of the work has been done relative to what was meant to be. So challenging to bring it back. This is the chart I fall back on when people ask, but what if US shale grows by 3 million barrels a day more than you forecast, or what if the OECD just switches to electric cars in entirety? And it's the breakdown of the budgets in OPEC countries. So what you can plot is the oil price on the x-axis here, just what do you need to balance the budget for these different countries, and what proportion of the world's oil supply would be running a budget deficit at the different oil prices. And where you come out is this green curve shown here, which says that once you get down below about $95 a barrel, then Saudi starts to run a budget deficit, and of the world supply from OPEC and Russia, 40% of that 55% is in deficit. So I just don't think you can get there. I think you'd see the cuts before you got to that level, as indicated by the suggestive cuts question mark circle in the middle of this chart. So that's the importance of the Middle East in the oil price. I guess I'd just conclude by saying the three key points, which are one, Middle East underrepresented, under-examined area of the global oil supply-demand balance, global hydrocarbon supply-demand balance. Two, great opportunity to invest if you can get it, and where you can make some of the best returns. And three, the resource potential is what underlies that, just chalk and cheese between the mature resource and production that we see in the developed world. So that's it. Thanks.
Thanks, Robert. I want to ask a question about investment managers and what they think, because they are an interesting set of people and have different priorities. If you're an investment manager sitting in New York, presumably you're telling companies you've invested in to invest in the US and not in the Middle East, crudely. Yeah. If you forgive me for that.
Yeah, that's certainly what you see is a return to a lot of the industry to just hunker down at home, where you have the certain regulatory environment, easier operating environment, and it's certainly the phrasing that you get at Marathon this morning just did exactly that. It just said, we are going to be selling our international portfolio and upping our investment 13% in the US, and $3.6 billion of new money earmarked for the Eagleford in the back. And I guess you know it yourself from Tullow. I mean, Angus has always said to me, you know, if you see Tullow Oil investing in Iraq, then run for the hills. And there are companies that you know from following them would never ever go there, unless you're about to make an announcement, in which case I cancel my comment. But you know you'd never go there. And investors like that. They like the discipline of saying, this is where we're going to play, this is our space, this is where we have an edge, and we're not going to be involved in areas where we can't control the export route, or have a difficult environment with the government, or there's just no real return potential. And I think what's most interesting for me on that theme is looking at the transition that I touched on in my presentation between southern Iraq and Kurdistan. So, you know, the Baghdad government doesn't take too kindly to investing with its northern neighbor. And what you've seen now is all of the majors that can invest in Kurdistan pretty much have taken a stab at doing that. Total have some blocks. Exxon, you know, very, very clearly did that at, even though it jeopardized West Qurna 1. The companies that haven't done it, i.e. BP and to an extent Shell, you know, they just have too much at stake in the south to actually go there. But I think that the will is there, and maybe a name like Statoil, you know, famously pulled out of West Qurna 2 at the start of 2012, and I you know, wouldn't be surprised if they had a look in Kurdistan, because they're out of Iraq and that they can go for it, and that's probably one of the hottest themes for the returns.
Okay, sorry. Anybody else got a question for Robert? Okay, yeah, please. Just hang on for the microphone. It'd be good if you said who you are and which company you're from.
I hope you're going to challenge my US as the next Saudi Arabia comment, because that's always a fun discussion. But anything else is welcome too.
Yeah. Hi, my name's Ian Schofield. I'm from Hydrogen Group. I just had a question. Do you have any insight in terms of Occidental? They're talking about potentially selling their assets in the Middle East. They're expecting a decision sort of before the end of the year. Do you have any insight or knowledge on that?
Yeah, I mean, it's a great question. It's exactly within the zeitgeist of what we've been talking about, which is to see companies stepping back from the Middle East and hunkering down in the States. My feeling is, I think it's a deal that is palatable, and the buyer would probably be one of the Asian majors. and it's just now just a question of price and timing. But I think the will from the US players to go home and the Asian majors to ramp up is there. So timing and price are the key details, really.
Okay. Anybody else? Right. Please. And same deal. If you could say who you are and where you're from, that would be great.
Well, Mark Davis from McKinsey & Company. Thank you for a great talk. I would actually like to take your bait and challenge you on the Saudi Arabia and the US issue. My question is this. Reputable players like Wood Mackenzie, IHS, and even McKinsey are quite bullish on the light tight oil boom reaching beyond 4 million barrels by 2020. Now, we're well aware of all the issues, the capex, the decline rates, many of the noise and water and other issues, but what is it that gives you the view that is sort of quite contrary to those populist views, if I can say that way?
Yeah, I think that the main thing that I haven't mentioned is linked into the resource distribution. And if I'm going to point to one data point, I mean, well, we could have a 3-hour discussion on it, but I'll spare everybody else, and we can have the normal day as planned. But the single data point that I would point to is to look at just a map. I love the maps because I can get my head around them quite easily. It's the sweet spot theory, right? It's that when you're drilling the core of the Baca and you're right there, you can get 1,000 barrels a day flow rate from a newly fracked shale well. And then you step just across into the next county, or you look at some of the wells in Montana, and two things. One, the flow rates start to get really marginal. And two, even within some of those regions that were producing strong results on new wells 2 years ago, 1 year ago, today they're producing less, like same place. So not about stepping to a new geography, but I think there's a greater degree of gradation within individual areas than perhaps factored into some of those more bullish estimates. And then, if you permit me to have one more comment, I think the other factor is to look at the productivity and what's driving it. So, it's easy to ramp up the output per well when you are also doubling your lateral length and tripling your stage count. And we've just always been a bit cautious on how much of the productivity gains are genuinely because of finding sweet spots versus plugging in more capital to it. And I was looking at this the other day. I think it's a really interesting example. If you think about like the capex per barrel, or the total cost per barrel for, say, a shale well, or something that people think about as one of the highest cost resources or most complex resource to develop. So what if you just pit US shales versus the Brazilian pre-salt together? And the kind of end-to-end cost at some of these wells, maybe it's just an average level, is running at about $20 a BOE for the shales versus 7 to 8 to develop, and then 6 to 7 to produce some of the Brazilian pre-salt. So the point I'm making there is I think that the disparity between excellent resource potential in the States and what you see in some of the international plays, even the ones that are regarded as really challenging, may not be quite as big as currently baked into some of those numbers, and maybe you'll see capital allocated away from the shales and into other projects. So those are, in a nutshell, kind of the three things I point to.
Okay, Robert, thanks very much
for taking
that.
The bait.
Thanks for the question.
Cheers.